Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. For those who celebrate it, I hope you're having a happy Easter break. It has been a big day, the end of a big week. So let's jump in. And first up, Wall Street is in turmoil as escalating trade tensions and the Federal Reserve's hands-off approach shake investor confidence. Fed Chair Jerome Powell's refusal to step in with economic support this week, coupled with President Trump's public demand for his removal, has intensified fears across markets already reeling from mounting tariffs. The fallout is sweeping. 90 of the top 100 exchange-traded funds, ETFs, of 2024, 90%, are in the red this year, with average losses of 13%, according to US-based Bloomberg Intelligence in a report published today, Friday. Even once high-flying assets such as cryptocurrencies and corporate debt are unraveling, with prominent funds like the Grayscale Bitcoin Trust ETF and the Investico S&P 500 Momentum ETF both posting significant declines. In a dramatic reversal of fortune, many of 2024's worst-performing mutual funds are now outperforming in 2025. The Cook and Bynum Fund, for example, has gained nearly 14% this year thanks to its focus on international markets, placing it among the top 2% of US portfolios. Quote, "The uncertainty around the policy changes with this administration is shaking the perception of US safety," end quote, said Richard Cook, co-founder of the firm. With inflation concerns looming, Powell warned that volatile trade policy could undermine price stability, ruling out the prospect of economic stimulus. Trump's retaliatory tariffs and abrupt policy changes, though justified as part of a longer-term strategy for American economic health, has, nevertheless, in the short term led to rising anxiety over America's economic direction. Major stock indices continue to slide. The S&P 500 is down in 9 of the past 12 sessions, and the US dollar has dropped more than 6% year to date. Volatility in treasury markets remains elevated, and investors are retreating into cash and gold. The SPDR Gold Shares ETF has pulled in over $8.4 billion this year, topping $100 billion in assets for the first time. Meanwhile, international plays like the DWS Invest Latin America Equities Fund have surged, up 13% this year as the weak dollar boosts emerging markets. The broader market mood remains grim. Quote, "You need to really restore the credibility of US markets," end quote. James St. Aubin, CIO at Ocean Park Asset Management, warned, adding, quote, "which are already under threat by virtue of our large deficits and potentially slower growth." End quote. Meanwhile, while we're still in North America, a US federal judge ruled yesterday, Thursday, that Google illegally monopolized key segments of the online advertising market, dealing another major blow to the tech giant's dominance in digital advertising. The judge found that Google, a unit of Alphabet Inc., abused its monopoly power in the markets for publisher ad services and ad exchanges, but cleared it of monopoly conduct in tools used by advertisers to buy display ads. The ruling is the second in a year to declare Google an illegal monopolist. Quote, "The court's ruling is clear. Google is a monopolist and has abused its monopoly power," end quote, said Assistant Attorney General Abigail Slatter. The judge's 115-page opinion concluded that Google engaged in years of exclusionary behavior, pressuring publishers to use its ad technology tools and eliminating competitive features. This conduct, she wrote, harmed competitors, publishers, and ultimately internet users. Although the Justice Department had hoped to break up Google's ad tech business, the judge said the company's past acquisitions, such as DoubleClick, were not inherently anti-competitive. Still, she left open the possibility of future remedies. Google said it would appeal the decision. The Justice Department hailed the verdict as a major win for antitrust enforcement and the open web. Next up, we move to Asia. Steel exports from Japan and South Korea to the United States plunged in March following the implementation of new US tariffs, deepening trade friction between Washington and its close Asian allies. Japanese steel exports to the United States dropped 16.6% year-on-year, while South Korean suffered a steeper decline of 24%, as a 25% tariff imposed by President Donald Trump on March 12th began to bite. The move is part of US President Trump's broader efforts to address America's trade imbalances. The abrupt, unilateral nature of the tariffs has stirred diplomatic tensions and disrupted global supply chains. Japanese exports of iron and steel products fell 8.2% overall in March, while South Korea recorded a 14.1% drop, according to official data released yesterday. Thursday. Despite the slump in metals, Japan's total exports rose 3.9% in March, marking the sixth consecutive month of growth, fueled by a surge in shipments ahead of the new tariffs. Auto exports rose 7.2%, and chip-making equipment exports climbed to 4.2% during the month. Quote, exports have benefited from some tariff front-loading in recent months, end quote, said Jae-min Bang, associate economist at Moody's Analytics, adding, quote, but the deteriorating global trade outlook suggests shipments will take a significant hit in the coming months. End quote. Japan is also facing a 24% so-called reciprocal tariff announced in early April, but delayed for 90 days. A separate 25% levy on imported vehicles enacted the 3rd of April has already impacted Japan, which make up 13% of US vehicle imports in 2024. Japan's trade surplus stood at 544 billion yen, $3.8 billion for March. Meanwhile, Taiwan Semiconductor Manufacturing Co., TSMC, will produce around 30% of its most advanced 2nm chips in Arizona as part of its strategy to support a self-sufficient US semiconductor supply chain. TSMC's chairman and CEO, C.C. Wei, confirmed the world-leading chip maker will accelerate construction of its second and third fabrication plants in the state, citing consumer demand and US efforts to build an independent chip cluster. Speaking on Thursday, Wei dismissed speculation about a potential technology sharing partnership with Intel, stating, quote, TSMC is not engaged in any discussion with other companies regarding any joint venture, technology licensing, or technology transfer and sharing, end quote. Construction of the second Arizona fab may be brought forward by at least 2 quarters from its original 2028 target, while a third facility is set to break ground later this year. However, Wei warned that ongoing labor shortages and regulatory hurdles could affect timelines. Despite tensions over the Trump administration's reciprocal tariffs, TSMC reported no changes in customer behavior, though Wei acknowledged broader geopolitical risks. The company remains cautious, with a stable 2025 capital spending plan of $38 to $42 billion and forecasted revenue growth in the mid-20% range. AI chip demand continues to drive strong performance, with Wei saying, quote, 3 months ago we were barely able to supply enough wafers. Now it's a little more balanced, but demand is still very strong, especially in the United States, end quote. NVIDIA and AMD are key customers for the Arizona fabs. TSMC's Q1 net profit surged 60% year-on-year to $10.9 billion, while revenue rose 41.6%. China's share of revenue dropped to just 7%, reflecting TSMC's alignment with US export controls. We are living history as the world goes through tremendous change. If you want to be on top of the most important updates in the biggest and most dynamic markets in the world, North America, Asia and Europe, make sure you are subscribed to Market Update, and you will be. If you're getting some value from today's episode, don't forget to hit the like button. Next up and finally for today, we move to Europe. As the US-China trade conflict escalates under President Donald Trump's tariff regime, Beijing is ramping up outreach to the European Union, hoping to offset the economic fallout by deepening trade ties with the bloc. Yet despite a flurry of diplomatic and commercial overtures from China, deep-rooted mistrust and policy disagreements continue to cloud prospects for a meaningful detente. On my other channel, China Update, we have been following these developments for months now. Chinese leaders and officials are actively pursuing closer cooperation with the EU, dispatching trade delegations to European capitals and pitching China as an investment destination. General Secretary Xi Jinping recently told Spanish Prime Minister Pedro Sanchez that the two sides should, quote, jointly resist unilateral bullying, end quote, a reference to Washington's trade policy. Trump has imposed tariffs of 145% to 245% on Chinese goods, prompting Beijing to retaliate with 125% levies. Regular viewers will be very familiar with all this. Meanwhile, the European Union faces 10% tariffs from the United States, which could double if trade talks falter. While EU officials, including Commission President Ursula von der Leyen, have spoken of the need for, quote, stability and predictability, end quote, any realignment with Beijing would require overcoming significant hurdles. Trade imbalances, restricted market access in China, and political friction, particularly Beijing's tacit support for Russia's invasion of Ukraine, have eroded goodwill in Brussels. Chinese exports to the EU vastly exceed imports. raising concerns over industrial overcapacity and market dumping. The EU has launched multiple trade defense probes, slapping heavy tariffs on some Chinese goods. In response, Beijing has targeted European agricultural exports with investigations of its own. Despite these tensions, some in Europe, particularly German businesses and especially German car makers, with deep ties to China, are advocating for renewed engagement. A recent policy paper from German firms in China urged Berlin to support their interests more actively. China's Ministry of Commerce has recently organized outreach events in Stockholm, London, and Budapest, aiming to attract investment and ease market concerns. Chinese exporters are also shifting focus toward Europe, seeking alternatives to the US market. Still, European business sentiment remains cautious. A recent survey by the EU Chamber of Commerce in China found that over a quarter of respondents were pessimistic about growth in the country, and nearly half were concerned about profitability. Analysts suggest that unless the United States and EU resolve their trade differences, Europe may find itself forced to choose between two trade giants. Quote, even a bad deal with Beijing could be preferable to a two-front trade war, end quote, said Noah Barkin of the Rhodium Group. As we have discussed before, however, the biggest practical issue is that both these giants, the EU and China, need markets to export to, something that the US provides, but neither can provide each other. For now, both sides appear willing to talk, but trust, not tariffs, may be the hardest obstacle to remove. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Friday. Have a restful weekend. For those who celebrate it, have a good Easter. There may be an extra episode of Market Update this weekend, so I will either see you during the weekend or for a new week of updates on Monday.